What's going on, everyone? Hootmoney here with another video for you guys today. Today, we're going to be talking about Netflix because Netflix is down 37%. If you bought puts yesterday, I am jealous. I am jealous because those are printing like crazy and you are probably a little bit richer as of today. But anyways, the gist of today's video is whether or not Netflix is now a good value deal. Should you buy this dip? Should you sell off your Netflix shares or what? It's going to be a little bit different than most of my videos because obviously I usually talk about highly shorted stocks, but at the same time, you got to be looking at all stocks in the stock market because clearly there are opportunities across the board. And with Netflix being down 37%, it's really just setting up volatility in general for this earnings season. So it's going to be an exciting one. So drop a like on the video if y'all enjoyed this content. Subscribe to the channel if y'all are new. Join Hootmoney trade alerts if you guys want to know all of my buy and sells. I'm about to make a bunch of long-term investments very, very shortly. So if you want all of that, then click that link down below. Anyways, my friends, that's about it for that. Let's get right into the video. All right, so as you guys can see, it's down 37%. It's at a $97 billion market cap. It's absolutely insane. I mean, look at this dip. And if we're just looking at how much this thing has dipped from its high of $700 per share all the way back at the end of 2021, which wasn't even that long ago, this is down super substantially. And this is not a cryptocurrency. This is not a penny stock. This is, or at least it was, over a $1 billion company. And it's basically wiped out all of its gains since the beginning of 2018. So looking at their earnings report across the past few quarters, you guys can see the revenue for Q1 2022 was about $7.8 billion. This is up from the Q1 revenue of $7.7 billion. So overall, they have still been increasing their revenue on a year-over-year and quarter-over-quarter basis, which is essentially what they want to be doing. They want to be showing that they are a growing company. However, if we're just looking at the global streaming paid memberships, this is super, super important. And then also the net additions to those global streaming paid memberships. It's crazy because this is the first time we've really seen their users go down. And as you guys can see, Q1 2022, their user base has gone down. And if we're just looking at their paid subscriptions going all the way back to 2014, this is the first quarter that their paid subscriptions has decreased. It's been over 10 years in total since their paid subscriptions has decreased. Now, this is partially due to other competition such as Disney Plus, Hulu, Prime Video, and other platforms, right? Because Netflix was only really competing with, I guess, platforms like YouTube and Hulu in the past. And then all these other services like Disney, Prime Video, Paramount Plus, all of these other services have emerged. And as you guys can see, Netflix has actually been gaining market share, but also Disney Plus has been gaining market share. Prime Video has been gaining market share. Hulu's been being pretty flat overall. And the whole market in general, just the streaming market has been growing. As you guys can see, it's up 0.6% from May of 2021. So the reason that they lost all these subscribers in the first place is because they decided to raise prices on all US plans. So in January, the company's standard plan rose to $15.5 from $14. So a decently significant increase. And then the 4K plan rose to $20 a month from $18. And you guys can see from this chart on price hikes, their 4K plan went from $12 in 2013 all the way up to $20 right now, which is a pretty significant sum. So in economics, this is called the law of demand. So if price goes up, the quantity demanded goes down. This is just simple economics, right? But if the price decreases, the quantity demanded goes up. So throughout throughout Netflix's life cycle, even with the price hikes, they were able to continue to grow their user base, right? But now we're finally seeing the law of demand kick in because, again, the most recent price hike right here has actually led to a decrease in subscriber growth. I'd like to quickly thank the sponsor of today's video, which is Moomoo, licensed FINRA broker that does absolutely zero payment for order flow and gives away free level 2 data. It has the best brokerage promotion by far right now. All you got to do is click the second link in the description or first link in the pinned comment section to sign up. You got to click those links or you won't get the promotion, and make an account, deposit $1 on their platform. You get up to $7,000 in free stock. In addition to that, you can get up to $10,500 by depositing $2,000. So in total, that would be up to $17,500 that you could potentially get from this deal. So it's by far the best brokerage promotion. Again, no payment for order flow, free level 2 data. Check it out using the second link in the description, first link in pinned comments section. But with that being said, let's get right back into the video. So this brings me into the next point, talking about the product life cycle. And as you guys can see, there's the introduction phase. This is pre-revenue. This is before the company has ever been kicked off in the first place. They might even be a private company at this point. The growth stage, you're likely on the public markets. You're rapidly increasing your revenue each and every single quarter, and then you move into the maturity stage where that starts to plateau, and Netflix is definitely in what seems to be the maturity stage. So during the growth stage, you're going to be paying a premium for expected future growth of that company. Once you're in the maturity stage, the company starts acting more like a value company, and you have to be judging it almost solely based off of their fundamentals and their financial statements, because the growth will be slowing down. So it's going to be more of a value company. And at this point, that's when investors start to expect having dividend payments and all of that stuff. And if we're just looking at the product life cycle and we're comparing it to this chart, you're essentially seeing the growth slow down. And for the first time, it has actually gone down. So Netflix may in fact be right here in the maturity stage. Now, what do companies do to combat this? What do companies do to continue to grow while they're in the maturity stage? They do this thing called a product extension. Well, they also said in their earnings call that Netflix explores a version with ads as subscriber base shrinks. So they are willing to completely create a new product altogether. As you guys can see right here, they have the basic subscription with no HD, they have the standard subscription with HD, and they have the premium subscription with 4K. They've never ever had ads on Netflix, and that was always something that made people want to have a Netflix account, because there's not going to be any ads. Netflix also hasn't really considered it, and it's definitely been an option because their competitors such as Hulu have versions that have advertisements on it already. So to combat the slowing growth and the movement into the maturity stage, they're adding a product extension, and that's a good thing. This is going to allow Netflix to continue to grow, but it's also essentially the company admitting that their core business model has reached this maturity stage, which again, that means you can't be paying such a huge premium for a growing company once it does reach that maturity stage. And that is definitely the reason why this has sold off so much. So the real question that you should be asking at this point, with Netflix down from a high of $700 per share to a low right here of $220 per share, is this a value investment? So if we're taking their market cap right now of about $98 billion, we divide it by their net income from the year of 2021 of $4.86 billion, that would put us at a price to earnings ratio of about 20. This is one of the lowest values that you will see in big tech, but historically speaking, it could in fact get lower, especially if Netflix is now in that maturity stage and not in that growth stage. Again, usually when you have a price to earnings ratio of above 10, you're paying that premium because of future expected growth. So there's definitely still room for it to come down. But if we're just comparing it to some of its peers in the tech industry, a 20 PE is pretty low. You can see that Amazon has a 63 price to earnings ratio. Google has a 22 price to earnings ratio, which is not bad at all. Meta has a 16 price to earnings ratio, which is still lower than Netflix. Tesla has a price to earnings of 92, which is very, very high. Microsoft has a PE of 30, and then Disney has a price to earnings of 28. So while there definitely is some room for Netflix to continue moving down, it is definitely on the lower end of the spectrum in terms of a big technology company, which means that it could definitely be a good buying opportunity. If we're just looking at the FANG Plus index, it's down from a high of 7,897 from November 12th, 2021 to what it's trading at right now of 5,735. So tech in general is down significantly. You can also just look at QQQ, right? If we type in QQQ, we can see even the NASDAQ is down significantly. So in my personal opinion, if you are betting on a NASDAQ recovery, if you are betting on big tech coming back eventually in the future, which it usually does, the market usually comes back and goes up over time and reaches new highs, then Netflix is one of the better options to be getting into in terms of a value proposition. So all in all, what I think this earnings call did cement in on Netflix, and the reason that it's down so much today is a movement from the growth stage of a company's life cycle to the maturity stage, or essentially the value stage, where a company needs to have actual legitimate fundamental value in its financial statements because it is no longer pricing in excess growth in the future, and you can't be paying a premium for excess growth if the company, well, is showing proof it's not really growing anymore, right? And especially with that product expansion, it really does show that Netflix is now in the maturity stage of a company. It has more competition, and overall that means it has less market share and the company's value would go down. So we have to be looking at this from a fundamental perspective, and quite frankly, there's potentially more room for it to come down. But overall, if we're looking at other big tech stocks and comparing the multiples, Netflix is not in a terrible position for value. So you got to be planning to hold this one long term if you want to get in on it, but it is definitely a decent deal. If you don't want to just jump all in on it at once, you can average into it. Dollar cost averaging, just look that up on Google if you don't know what it is already. But yeah, that's about it. That's my thoughts on Netflix. I hope you all enjoyed. Drop a like on the video if you guys did. Subscribe to the channel if you guys are new and you want more content, and check out Moomoo if you want up to $7,000 in free stock as long as you deposit $1 on their platform. That's about it for the video. I hope you guys enjoyed. If you want to check out Hootmoney trade alerts, it's that first link in the description. You can see when I might be buying Netflix or any other stock, and any other questions that you might have with me personally. Join Hootmoney trade alerts. That's that first link below. Anyways, my friends, that's about it for now. I'll be seeing you guys next time.